Good morning. We're going to finish up Chapter 8 today. There is a question out there in Learning Catalytics. It will be open for a few minutes. Make double sure that when you submit questions in Learning Catalytics, I think sometimes when you submit your answer, make sure you submit it and that you get that your response has been hidden screen to confirm that your answer has been received. We are doing accuracy, again, the same formula. I would expect that most of here on out. So due this week is the homework for chapters 4 and 8. That is one assignment. There is one homework problem that we won't cover in class here. I'll send out a link to a video this afternoon or tomorrow morning for that. There is exam 2 info quiz. So those are the two items that are due. The exam info quiz is simply a multiple choice, like 5 questions, really easy, just to make sure we're on the same page about the exam. The practice exam 2 is due before you take exam 2. So practice exam is not due this weekend. It counts as a quiz. It is required. You can take it up to 5 times. Your average, your score is your average. And that is due, practice exam 2 is due by 4 p.m. on Wednesday next week. There is no class next week during exam week because I don't like having class when you're working on an exam. That seems like enough to do in 1 week is take an exam. So there is no class, so this is our last class before spring break. So exam 2, Monday, March 16th through Wednesday, March 18th. It opens up at 9 o'clock Monday morning. It will you have to start it by 4 p.m. on Wednesday. If you're in sections 5 or 6, make sure you schedule with ProctorU in plenty of advance. And then if you're in sections 1 or 2, we don't know what to expect next week. This is the week last year, the comparable week, was when we had 4-hour lines for the exam in the lab. And I don't want that to happen again. So our exam, you have to start by 4 p.m. Wednesday. There are 8 exams going on next week in the lab, and there's some pretty big sections in there. So there are a lot of students taking exams next week in the lab. Rule of thumb, you're generally better off in the morning, and certainly Monday and Tuesday should be good. Don't think, oh, Wednesday's good because it's way away from Friday and Thursday. With spring break, people are trying to get out of here for their spring break plans, so they take it earlier. That's why we have no way to predict what the labs are going to be like next week. So go early, give yourself plenty of time, and don't go in there and have work starting in 2 hours and you can't take the exam till after spring break. Because if that happens, you get a 0. If you don't take the exam, if you don't start it by 4 p.m. Wednesday, you get a 0. So you absolutely, if you wait to take it till 4, that's absolutely fine, but you're more of a risk taker than I am. Okay, so if it were me, I'd be taking it Monday or Tuesday, and then you have a backup plan if something goes wrong. Okay, so there is a question in Learning Catalytics. What's due this Saturday? So we did have this question on Monday. It's a repeat. Okay, 97% of you have this right. We're going to have this question open for about 10 more seconds. Actually, it'll be open for a little bit longer, so pretend it closes. You're not going to see the answer pop up because we're going to leave it open for a minute or so after this. So the answer on this one is Chapter 4 and 8 homework and Exam 2 info quiz. The practice exam is not due this weekend. So what we're going to do today is we're going to do the accounting for securities, for available for sale securities. We're going to do the accounting, talk about debt securities, bonds, and then we're going to talk a little bit about time value of money. So we're going to start with available for sale securities. Again, that question is still open, so if you're just joining us, get into Learning Catalytics quickly. Haley will put the session ID in the chat window if you need it. Okay, so starting with available for sale securities. So I'm going to use examples today largely. Intel purchases 1,000 shares of Hewlett-Packard common stock at a market price of $44 a share. So Intel is purchasing equity securities. Intel is purchasing Hewlett-Packard stock. And the reason Intel's doing this is because they have extra cash. They want to make some money on their cash. So they have a choice. Intel could invest in its own operations, but maybe it doesn't have that long of a horizon. Maybe it doesn't have any good projects outstanding right now. So it's got extra cash. It's going to put that extra cash in equity securities or debt securities. So in this case, it's going for stock in Hewlett-Packard. So it purchases 1,000 shares of Hewlett-Packard common stock at a price of $44 a share. So it has spent $44,000. It intends to hold this investment for longer a year and then treats it as a long-term available for sale. So that we are out in long-term territory when we're more than a year, and it's about intent. So the entry to record the investment will be to debit the investment. So AFSS is just an abbreviation for available for sale securities. So we're going to debit the investment. Commonly, you'll see something like long-term investment. It might not be investment in available for sale securities. But we're going to debit the investment for $44,000. We're going to credit cash for $44,000 to show the purchase. So basically, with these securities and with the bonds, there's basically roughly 3 journal entries for each that we have to understand. So when we first buy an investment, what's happening is we're taking a short-term asset, cash, and we're moving it into a long-term investment. And our goal here is to earn money on our excess funds while we have them. So we've got this, and with a stock, we also may have the goal of selling it later at a higher price. Okay, so we have this debit to investment and credit to cash. Next, now let's assume that Intel receives a 20-cent cash dividend. So when you have stock in a company, there is a high possibility that you will get dividends on your stock. Companies are not required to pay dividends. Companies don't have a legal obligation to pay dividends until they're declared. And so as a stockholder, you may or may not get dividends. Frequently, you'll know from the history of the stock if you would expect dividends or not. First Energy stock, they have a historic policy of paying dividends every quarter. Many other companies pay dividends every quarter. Other companies take a different tact and say, well, we don't want to give you money. We're still reinvesting our money. We're in a growth stage. We don't have the money to give shareholders, so there'll be no dividends. And shareholders account for that in the price of the stock. That's reflected in the market price of stock. So a company does not have to pay dividends. It can, how it decides that is a big discussion for the company. So in this case, Intel is receiving a 20-cent cash dividend per share. So what we're going to do here is we're going to debit cash. And we're going to take the $1,000 times the 20 cents to get the $200 cash we're receiving, and we're going to credit dividend revenue. And so we are receiving dividend revenue. I said there were about 3 journal entries. So we have the first one when we purchased it, the second one we get dividend revenue, and then this third one deals with, at the financial statement date, we're going to revalue this to fair value. And so what's fair value? Fair value is the market value. So this is an available for sale security, meaning we're holding on to it, it's long term, but we could sell it if we need it. So that we revalue at the balance sheet date. So generally accepted accounting principles requires that if we issue financial statements, we have to report these securities at fair value. Fair value is market value. We go to the Wall Street Journal, we go to Yahoo, we go wherever, we look up the market value for the stock, and that's what we report it at. Now, when we adjust a stock to fair value, we're going to adjust to an allowance account. So this next slide, basically what we're doing is we start with the original cost of the investment, and then we have an allowance account. If the fair value is greater than our cost, meaning it's worth more now than what we paid for it, we're going to debit the allowance to adjust investment. So there's an allowance account for investments. So we're going to debit it if the fair value is more, meaning we want to increase the value of the investment. Or if the fair value is less than the cost, meaning we've lost money, so the investment's worth less than what we paid for it, then we're going to credit the allowance account. So we're just looking to adjust the total the carrying value of the investment. The carrying value of the investment is the original cost plus a debit balance allowance or minus a credit balance allowance. Just as a reminder, the slides that we have today are on Blackboard, so if some of these slides coming up, if there's a lot of example numbers to write down, know that those are available on Blackboard. Okay, so we've taken the original cost plus or minus the allowance account to get the carrying value, and that carrying value is fair value. Okay, so the example we have is continuing with this Intel example. Remember, we paid $44,000 for the Hewlett-Packard stock. Now assume that the quoted market price of the stock is $46.50 a share. We paid $44 a share, and making the fair value of the 1,000 shares of the Hewlett-Packard common stock $46,500. So we paid $44,000. That was 2 or 3 slides ago. We paid $44,000. Now the stock is worth $46,500. So it has increased in value. So what we're going to do is we're going to be debiting that allowance account. And now we're going to debit the allowance account for the amount that it's grown, the increase in fair value. So we're going to take the $46,500 current market value, subtract the original cost, and that's how we get the $2,500. I'm debiting the allowance account because that is increasing assets, so unrealized gain. Now, the credit here is unrealized gain. Unrealized gain, remember this word unrealized gain, unrealized. We had this back in chapter 5. And this is really important. We're going to see it coming up on a question here. But unrealized means that we have not sold it. Okay. The only way to get an unrealized gain or loss is through a change in market value. Okay, so what we're doing here is we are adjusting, when we adjust the balance of the investment, we're debiting this allowance account, and we're crediting unrealized gain. So this is a case where we have the investment has grown in value. We're going to do a homework problem where the investment has declined in value. So let's see. Okay. So we're going to do that. So now what we're going to do is we're going to do short exercise 8.1, okay? And we're going to see this in play. So short exercise 8.1, we have a table of transactions. So we have a table of things we did, and looking at the requirements, the first requirement is to journalize their investment transactions. So we're going to journalize those 3 things in the table above. So the first one is purchase 600 shares of Bison stock, paying $17 a share. Okay, so what's happening there, we purchased stock, we have purchased 600 shares at $17 a share, so we're going to debit the investment for $10,200, credit cash. We got the $10,200 by taking 600 shares from $17 a share. So we're going to debit the investment in the available for sale securities and credit cash for the $10,200. Okay, next up, so that's the first entry. The next entry down is we received a cash dividend of $1.24 per share on that stock we bought. So we had 600 shares we bought times $1.24. So what we're going to see here is we're going to increase cash. We're getting cash for the dividend, and we're going to credit dividend revenue for the $744. And then our third entry is a little bit different. This third entry is we come to the end of the year and the investment is now worth $5,500. We paid back in April 10th, we paid $10,200 for this investment. That was our cost. Now on December 31st, we have a market value of $5,500. So the first thing we have to do is we have to figure out our unrealized loss, okay? And how would I know it's a loss? It's because it's worth less than what it was when I bought it. So I purchased it for $10,200. I had a current value of $5,500, so I have an unrealized loss. Now, this is something I would write down. Make sure it was in my notes somewhere. Unrealized gains and losses only come from changes in market value. Unrealized gains and losses only come from changes in market value. You're going to have a question on that one coming up here. But when you see an unrealized gain or loss, the only way that arose comes only from changes in market value. Okay, so we figured out the unrealized loss because this investment has fallen in value. So now we're going to do the journal entry, still in part one. The journal entry for this then is we're going to debit unrealized loss and credit the allowance account for the amount of that decline in value. So we've done part one. Part one is saying here's these three transactions we did. So we had the purchase of the stock, the receipt of the dividend, and then the change in market value. This is an available for sale security. So next up, in part two, it says, assume that this is the Tiffany Company's only investment. How will this be shown on the income statement? Note that it's asking for the income statement and other comprehensive income. So the income statement will report the dividend revenue. So the income statement, we've got the dividend revenue. Now that unrealized loss we have actually shows up on the statement of other comprehensive income. If you want to sound like you know what you're doing when you're talking to someone about some financial statement, use the acronym OCI. OCI is lingo among financial analysts and accountants for other comprehensive income. So other comprehensive income has an unrealized loss. So we have on the income statement the dividend revenue, that mark-to-market thing, that goes in OCI. And then the third requirement, show how to report the investment and any unrealized gain or loss on the balance sheet. So the second requirement was income statement and statement of other comprehensive income. Now we're looking at how to report the investment and any unrealized gain or loss on the balance sheet. So this one on the balance sheet, you're going to see two parts. Now, for this one, rather than writing all this down, if you're attending online, do a screenshot. Or if you're in here, you can take a picture. You don't need all of this, but the point here is in assets, these long-term available for sale investments would be shown at market value. They would be shown at $5,500. And then down in stockholders' equity, you would see under accumulated other comprehensive income, the unrealized loss on investments. Notice that unrealized loss on investments is negative because it is a loss. It reduces equity. If it were a gain, it would be positive. The word there, instead of document, because I'm an accountant, there's a question in the window about how do we document the purchase of the shares, how do we document the dividends again. We don't use the word document because document means that we have invoices, we have criteria. There's a very specific documentation that's going on of all this, but what we're talking about here is recording the entries. Recording the entries is different from documenting. An entry isn't a document. The documents would be the receipt from sales, the purchase confirmation, those things. So I just want to, and I know what you're asking, I just want to clear up the terminology a little bit. Yeah, that's fine, and I understand that. It was just that accounting thing. So, okay, so we're done with exercise 8.1, and what we're going to do now is we have a question coming up in Learning Catalytics. So this one, unrealized gains and losses from available for sale investments arise from what? The purchase of an investment, so the sale of an investment, changes in the market value of the investment, or D, management's decision to adjust the value of the investment. Okay, unrealized gains and losses from available for sale investments arise from what? We're going to have this question open for about 10 seconds more. Remember to submit your answer. You should be seeing that your response has been hidden after you submit your question, your answer. Oh, that's, whoops. I did that for my other class. No, it wasn't changed. There we go. Okay, sorry. There. Look in the chat room always for the session ID. Okay. Okay, unrealized gains and losses from available for sale investments arise from what? I don't know, I'm going to walk over and watch his next question. Can you submit an answer again for me? Oh, so you just answer it with multiple choice. It's with the clicker ones you have to submit, the tap ones. Yes, okay. So yes. I hope you answered the right answer when I didn't mess you up, right? Okay. I just thought I'd ask you to submit any answer. Okay. So we're good. We're getting closer. Okay. So that answer is changes in the market value of the investment. That is the only thing that can give rise to an unrealized gain or loss. If you had a realized gain or loss, that would come from the sale of the investment. Yeah, the submit button, I didn't mean to confuse anyone. The submit button is on the questions where you click on them. So we'll have one or two of those later on today. Okay, next up. So we're going to leave the equity securities, the stock investments, and now we're going to move on to long-term investments in debt securities. So this is where we bought the bond of another company. So this is kind of the relationship of where we're going with this. Our chapter right now is looking at it on the asset side. So we have the investor who's buying the bond. Why would I buy a bond as an investor? Because I have extra cash and I want to earn some money. As an investor, I can put my cash in the bank and earn 0.5% interest, or I could take my cash, and another option is to buy the bond of another company, and they will certainly pay me more than the 0.5% I can get in the bank or whatever the current rate is. So in this chapter, we're looking at it from the investor standpoint because we're in the asset section, long-term assets. And as an investor, I have an investment in the bond, and I have interest revenue. What we're going to be doing after spring break is we're going to have the issuing corporation. This is going to be, the issuing corporation will have a liability. Why does the issuing corporation issue bonds? Because they want to borrow money. Banks do not have enough money to loan to every corporation. And the banks are typically the most expensive source of cash for corporations to use. So corporations instead go to the market, and there's lots of big pension funds that want bonds. There's lots of retirement funds that want bonds. Bonds are a part of any balanced portfolio. So companies will issue bonds, and they basically say, we're borrowing money from you, we will pay you back at this certain date in the future, and we'll pay you interest in the meantime. So they have a liability for the bond, and they have interest expense. The two things mirror each other. We have the investment in this chapter, so we're looking at it from the investor standpoint. Next chapter, after spring break, we'll look at it from the standpoint of the liability side. So in this chapter, we're looking at it as an investment. Okay, now, if the investing company intends to hold until maturity, so we buy this bond, it's a 4-year bond, 5-year bond. Bonds can be all different lengths. If we intend to hold it to maturity, our intent, we account for it as something called amortized cost. And we're going to talk about what that is coming up here, but it's easier to illustrate after we've actually done it. So we're going to get to that. Okay, so this is an example we're going to do. We purchase $10,000 of 6% CBS bonds at a price of 95.2 on April 1st. Wow, there's a lot of information in that sentence for us to know. So we purchased $10,000. That $10,000, that's the face value of the bond. That's what Intel is going to get at the end of the maturity value. It's going to get $10,000. The 6% is how much interest these bonds pay. So CBS is going to pay Intel 6% a year. That percent is always going to be quoted on an annual basis. So if you see a 4% bond, it pays 4% a year. It might pay interest twice a year. Most bonds pay interest twice a year, but the interest rate is always shown as an annual rate. So this is a $10,000 face value bond paying 6%. So that 6% will not change. It's 6% of the $10,000. So right off the bat, I know these bonds are paying $600 a year, right? 6% times 10,000. That is how much interest these bonds pay. Continue with that sentence, that 95.2, what that is that's how we talk about how we sell the bond, what price we sell that. This bond's being sold at 95.2% of its face value. So you could see 95.2, you could see 101.1, and that's referring, you could just look at that number and say percent. So it's 95.2%. You don't say percent. The quotes are always talked about numbers like that, 95.2, 99.1, 101.1, whatever it is. That is the percent of face value the bonds sell at. And we'll talk about, in just a minute, I'm going to get through these facts, and I'm going to talk about why we would pay a different amount other than 100%. So we purchased the bonds, $10,000. That's the face value. 6% is the annual interest rate at a price of 95.2. We intend to hold the bonds till the maturity date. The maturity date is 4 years from now. Okay? So these are 4-year bonds, so they're long-term. Interest rates are semi-annual. So these bonds are going to pay interest April 1st and October 1st. And we bought them April 1st, so the first interest payment date will be October 1st. And then the bonds mature on April 1st, 2018. They'll be outstanding for 4 years, 48 months. Okay, so 4 years times 12 months a year. So those are our basic facts. Now, this bond is selling for a price lower than its face value. And let's talk briefly about that. We're going to see it a couple times today. We're not going to get real deep into it. If you've had finance, this should not be a surprise to you. If you've had finance, this chapter and next chapter will be a lot easier because you'll be familiar with this. But these are 6% bonds. So let's talk about from CBS standpoint. So CBS issued these bonds. When CBS issues these bonds, it's borrowing money. It's going to the market and saying, hey, I've got bonds, I'll pay you 6% and I'll pay you back in 4 years. So I'm going to pay you 6% interest every year. I'm going to pay you back the $10,000 4 years from now. And that's great. Now, when a company does a bond issue, many months in advance it's planned, and they pick an interest rate to pay. So CBS picks 6%. There's all different theories about what interest rate you pick. So companies pick their interest rate. So then when they go to market, the market rate is never going to be what you picked unless it's just stupid, weird, dumb luck. Your market rate of interest is what the market is paying on similar bonds. So the market being this conglomeration of similar companies with similar bonds and similar risk characteristics, the market rate exists. So CBS goes to the market with their bond that pays 6%. If the market's paying 6%, then rational investors will pick CBS's bond just as likely as someone else's. Everybody's paying 6%, market rate 6%. That's selling at par. Now, in this case, what happened is CBS went to the market with their bond that's paying 6%, and the market, let's say the market's paying 7%. Okay? So the market right now, due to all these economic factors, other bonds are paying 7%. And when I talk about other bonds, they're bonds that are virtually identical to CBS's in terms of risk and characteristics. So the market's paying 7%, CBS is only paying 6%. No rational investor is going to say to CBS, oh, I'll buy your bond, sure, give me your bond. I'll take 6% when I could go take my money and get 7% from everyone else. So no one is going to buy poor CBS's bond until CBS says, wait a minute, I've got it. My interest rate isn't as high as everyone else's, but I'll give you a discount. So I'll sell you my bond for 95.2%. There's a way they come up with that, but we're not going to worry about that right now. But I'll sell you my bond for 95.2% of its face value. So CBS sells its bond for 95%. For a $10,000 bond, it's going to sell this bond for $9,520. Okay, so Intel can buy the bond for $9,520. Why does that benefit Intel? Because at the end of the bond period, when the bond matures, Intel gets $10,000. So Intel pays $9,520 and gets $10,000. That difference, that discount that CBS gave them, is referred to as a discount, and it's kind of like prepaid interest. It's extra interest that Intel is getting because CBS's interest rate is less than what the market pays. Nobody would buy CBS's bond unless they give them a discount, and a discount is a way of increasing the effective interest rate on that bond. After all this I just said, you can do everything backwards. If the same thing could happen. If CBS's bonds were paying 6% and the market rate was 4%, boy, you'd have investors lining up at your door. Investors will pay more than the market value for a bond that pays more. And so CBS can demand more because they're paying more, and that's called a premium, and we'll see that coming up a little bit later. So the discounts and premiums are a way to level off what this bond pays related to the market rate of interest. Okay, so what we're going to do here, yes, the question is, so do they get 6% interest every year and $10,000 back at the end of the maturity period? Yes, that is true. So a bond, you have two amounts of money coming in. You have the 6% interest every single year. It says that we get interest twice a year, so we would get $300 every 6 months for the whole 4 years. And then at the end of the 4 years, Intel gets the $10,000. So there's two streams of money coming in here. There's one every 6 months we get interest, and then the maturity value at the end. What happens if the lending company goes out of business? That is one of the risks of bonds. And you'll hear about credit ratings of companies, and that's where the analysts are constantly evaluating the financial health of companies that are issuing bonds. And your bonds can be downgraded to junk bond status, and that means all of a sudden you have to give a huge discount. So when you hear about analysts downgrading things, that's what they're worried about, because if a company goes out of business and you hold a bond in that business, you are in line during bankruptcy proceedings to get some cash back. You will get money before shareholders. You will be paid in full before a shareholder gets any money, any equity back in a bankrupt company. But there's other creditors that come before you if you are a bondholder. Typically, the U.S. government comes before you for sure, and there's some other claims that come ahead of you. But if a company goes out of business, you could lose money on a bond. It's just not as likely, not as risky as stock. Okay, so let's go back to this bond, this $10,000 bond. We record the purchase of $10,000 6% CBS bonds at a price of 95.2. The bond issue price is going to be the 10,000 times 95.2%, or 0.952 times $9,520. Okay, so when we record this, we're going to have an investment. This one says held to maturity investment. You can also call it long-term investment, but you're going to have an investment for $9,520. And then we're going to have cash we paid of $9,520. So this is to record our initial investment. So we're shifting from current assets to long-term assets, but that's the purchase of our bond. We record our bond at amortized cost. So we record it at our initial cost. Okay, next up. Now our next item that we look at this is actually 2 journal entries here. And these, I said there were about 3 on every one we do, so this is the 2. The first one we're going to do is the receipt of interest. So receipt of interest is the first thing we do, and that's going to be this first one. Okay, so receipt of interest. We have these bonds that have a $10,000 face value paying 6%. This is October 1st. We bought these bonds April 1st. We've held them 6 months. They will pay interest, and the amount of the interest is going to be $10,000 times 6% times 6 months out of 12. You can also do it a couple different ways. You can take 10,000 times 3%, which is half the interest. It doesn't matter how you calculate, it'll come out the same. So we're going to debit cash for the 10,000, 6% times 6 months out of 12, $300, and then we're going to credit interest revenue. Okay, so that is the receipt of interest. That journal entry will be the exact same journal entry every single 6 months until this is over. They will pay, CVS is paying $300 every 6 months until for the life of the bond. The interest rate on the bond doesn't change. The interest rate on the bond is also known as the coupon rate. That does not change. They will pay $600 every 6 months for the life of the bond. Now, the second entry now is the amortization of the discount. And the amortization of the discount, this amortization of the discount is the second entry we're doing here. So that's down here. Now, we said that Intel paid $9,520 for this bond. The bond has a face value of $10,000. So there's a discount there, and that discount is actually $480. So that's the amount that CBS is giving Intel as to sweeten the pot, to say, buy our bond so that we know we're only paying 6% and other people are paying more, but buy ours and we'll give you this discount because you're going to get $10,000 at the end. So we have this discount. So what we're going to do is we're going to amortize this discount. And amortize the discount simply means let's take that $480 discount, which is the difference between the purchase price and the face value. So let's take that discount and just spread it over the 48 months. That's all we're doing here. We're going to say let's just spread that $480 out. So it's $480. It's 48 months. So you think the math's really easy. It's $10 a month. So for our discount, what we're going to do is we're going to have this investment. We're going to add the interest to the discount that we're amortizing to the investment. So we're going to take it right to the investment. So we're going to debit the investment for the discount, and we're going to credit interest revenue for $60. How are you doing learning highlights on the phone? He needs to clear his cache, Haley. That's what's happening. Yeah. Okay. So for this amortization of the discount, we're going to debit the investment directly, and we're going to credit interest revenue. And the amount of it is the discount spread over how many ever months our life of our investment is times the 6 months time. With the amortization of the discount, we're just spreading that interest over. So you can see what's happening here is Intel has interest revenue every 6 months from the interest they're receiving, and they're also recognizing interest revenue from the amortization of that discount. We say that these debt securities that we're going to hold to maturity, we say that they're carried at amortized cost. Notice that we don't have an allowance account here. We keep increasing the value of the investment for the discount. At the end of the 48 months or the end of the life of the bond, the investment will be at the face value. So the investment account will gradually increase over time. It'll end up at the $10,000. If we had a premium, it would be exactly opposite. It would decrease over time till we got to the face value of the bond. Why are we multiplying by 6? I'll take that one. Okay. So this is 6 months interest. There's 2 6s in this problem, so I'll deal with both of them. They pay 6% interest, so that's the 0.06. So we take the 10,000 times the 0.06 to get the interest rate. Now we're multiplying in the bond discount down below. I'm guessing that's the 6 we're inquiring about. We're multiplying by 6 months because we said, here's our bond discount of $480. That's the 10,000 minus the 9,520. That's $480. Divide by 48 months in the life of the bond, so we get $10 per month. And it's a 6-month period. We recognize interest twice a year with a bond. So 6 months times the $10 is that. So the 6 months, the 6 is 6 months for the interest period. Okay, so there is a section in your book. So what we just did here is straight line amortization. We took the amortization, divided by the 48 months, and we take the same $10 every single month. And that's straight line, and that's easy. Generally accepted accounting principles says, wait a minute, let's do something so that the effective interest rate on this investment is exactly equal over time. The effective interest rate on this investment is gradually decreasing over time if you calculate it. So generally accepted accounting principles say, wait, let's make this amount different every month so we can level that percentage that we're effectively earning. That's called the effective interest method. If you're an accounting major, you get to study it in future classes, not in this one. So when you're reading your book and you see effective interest method, we are not covering it in here. If we were going to cover it here, we would need an extra week. So we're choosing to skip it. Okay. Held to maturity debt securities. Oh. Let me see if we, okay, so I am going to do this. Okay, so some things I want to point out. First of all, we said the held to maturity debt securities were reported at amortized cost. Okay. Interest was received twice a year typically. You won't have this, I don't think, in a question today, but you will absolutely see this on, I can't imagine not seeing this on your exam. Okay, if the market rate is greater than the face rate, so the market rate's what the market's paying, the face rate is the stated coupon rate on a bond. If that market rate's greater than the face rate, you have to sell it at a discount. If the market rate is less than the face rate, you have to sell it at a premium. Now, you can sell it at a premium. The face value is what you receive at maturity, and over time you adjust the tiering value. It gets closer and closer to face value over time. Again, I'm going to be leaving this slide soon, but know that these slides are on Blackboard if you need more. But I would definitely know the market rate's greater than the face rate, that's what turns into a discount. If the market rate is less than the face rate, you sell it at a premium. Now, the next question I put up looks overly long, but it's not. So I'm going to put up this question, and I'm going to talk to you about, I think we're going to have to Google how to, I mean, tell them to Google it. Okay. So on January 1st, 2012, Plymouth Company purchased 100,000 6% bonds at a price of 90.4 and a maturity date. Interest is paid semi-annually. You don't really need that for this question, and Plymouth Company has a calendar year end. You probably don't need that at this point either. So basically that first sentence gives you what you need. The entry record the purchase of a bond investment on January 1st, 2012 is. Now, I'm going to give you a hint right now. The ST stands for short term. LT stands for long term. When we look at this, we bought it January 1st, 2012. It has a maturity date of 2016. We can assume they're going to hold it. So I am going to tell you right now that this is a long-term investment. So your answer has to be C or D. Okay? So there, you've got a 50-50 shot. But do it. This journal entry is going to look just like the journal entry we just did a couple slides ago on the Intel purchasing the CBS bonds. So you can look back to that for reference. So again, the answer is going to be C or D, but look back to that and make your choice. Okay, on January 1st, 2012, Plymouth Company purchased 100,000 6% bonds at a price of 90.4 and a maturity date of January 1st, 2016. The entry, when you record these bonds, will include a debit to what? We're going to close this in 10 seconds. Remember, get your answer in. Make sure that you're seeing your answer has been hidden screen. If it slowed down the, okay. You think it's pretty stable now? I mean, in terms of people answering, or no one knew? Okay, let's flip it. Okay, the answer is D. The long-term investment for $90,400, the journal entry for that, where how we get that, the journal entry, we're taking 90.4% times the 100,000 to get 90,400. We're going to be debiting long-term investment and crediting cash. Okay, now on to the last topic in the chapter, and this is time value of money. If you've had, we have an exam next week, so if you've had finance class, this is going to be a review. The time value of money means principal is the amount we borrowed or invested, and we'll be very interested in accounting when we talk about these long-term investments, that $1 today is worth more than $1 we're going to get 5 years from now. So we need to consider the time value of money when we talk about long-term investments. So the principal is the amount borrowed or invested. We'll see time value this chapter. We'll see it next chapter in liabilities as well. This process of figuring out what something's worth today is called discounting, because something's worth more today. The present value is worth more than something's future value. Okay, is this Danielle's Wi-Fi connection? Because it shouldn't be. Yeah. Well, we don't go by points in this class. Let me clarify that. I could have 5 points in a given day, but it's still, every class period is worth exactly the same. We go by percentages. The quiz is worth okay. So what we're going to be doing in here is we are going to be looking at what something's worth right now. And we use present value factors to calculate that. And I'm going to jump around a little bit and then we'll tie it all up at the end. So the first thing to know is when you calculate the present value of something, you have 3 options, at least 3 options to do it. You can use a financial calculator, you can use Excel, or you can use present value tables. You're welcome to use a financial calculator or Excel when you're doing your homework. The answers will be slightly different. But on the exams, you will be using the tables. So we're going to teach tables. I'm not going to require a financial calculator for 2 weeks. You cannot use a financial calculator on your exam because you have to use a plain calculator. Financial calculators are not allowed. Back to what we had this discussion earlier. You're not going to be able to use a financial calculator on your exam. In the computer lab, they provide you a plain calculator. If you're taking it ProctorU, it has to be a plain calculator. And you won't be able to use Excel on the exam as well. So we're using the tables. So today we're going to go through the tables. Tables are easy to use and actually kind of get a sense of where things come from. There are 2 tables to use. In your book, there's 4 tables. We'll talk about the 2 you don't need. But the 2 that you need, the first one is present value of $1 table. The present value of $1 table is for when you have a single sum of money. It's on page 487 of your book, and it will always be called, you will see this present value of $1 title. So it may not say Exhibit 814, but you will always see that. For the exam, by the way, the tables are provided within the problems as pop-ups. Okay? You do not take your own tables to the exam. You don't print them out. You use them. They'll be provided in a problem. If you need it, it will be provided to you. Okay. Okay, so this is for one single sum of money. We'll come back to that. And then the other table we use is on page 488. It's the present value annuity of $1. So that word annuity makes a difference. So present value annuity of $1. And this is, an annuity is when you have multiple streams of money. So we have those two tables. There's two more tables in your book. There's two more tables that will display whenever you have one of these problems. Those other two tables are called future value tables. There's the future value of a dollar and future value annuity. You do not ever need those. So just wipe those out. We are not calculating future value in this class. Again, we would need another week in the class if we're going to do everything. So the two that we use are present value. We're always looking for the present value of things. And so here's the rule about which table to use. The present value of a dollar table, it's for a single payment. When I talk about payment, it could be a payment you're receiving or a payment you're making. An example of this would be you're going to get $10,000 5 years from now. That's a single payment. Okay. The second one, present value of annuity. The annuity word is in the title. That means you're getting two or more equal payments. An example of this, you're going to get $1,000 every year for the next 10 years. That's an annuity, and you would use the present value of an annuity table. Okay, so basically the choice of table, the present value of dollar, one sum, the present value of annuity with the annuity in its title, that's for more than one payment amount of the same amount. Okay, so what we're going to do now is we're going to do one of these ones where you click in which table you would use. This is where you have to hit submit, I believe. Is there a submit button? Okay. Okay, so we have you receive $1,000 3 years from now. Which table do you use to calculate the present value of that $1,000? So we have the top table is present value of a dollar. The bottom table is present value of an annuity. So again, click it and then submit. Okay, you're going to receive $1,000 3 years from now. Which table do you use? We've got the present value of a dollar table and the present value of an annuity table. Present value of a dollar table, you want to listen up because a bunch of people have the wrong answer right now. So reconsider your answer. Present value of a dollar table is for a single sum. The present value of annuity is for when you're receiving the same sum over and over or paying the same sum over and over. We're going to close the question probably in about 15 seconds. Should be playing that Jeopardy music right now. Again, click it and submit it. This one you have to submit. You cannot. And you can't make a text response on this. You have to click on one of the two tables. Doing a text response below doesn't get you the right answer. You're going to have to click on one of the two tables and then hit submit. We're going to close this in about 5 seconds. It's your final countdown to get your answer in. Okay. Okay, we're going to close it. Okay, and that's the present value of a dollar because we're receiving $1,000 3 years from now, one-time payment. So we're using that top table. We'll do one more. Okay. You'll receive $1,000 every year for 4 years. Which table will you use to calculate the present value of the payments? So you're getting $1,000 every year for 4 years. Which table are you going to use? Okay, we're going to have this open for about 10 seconds more. So be sure to click in the table that you want to select and hit submit. Final chance, dwindling fast. Okay. Okay, and the answer is present value of annuity because we're getting that same amount over and over and over. So that's the big thing with this time value of money, is identifying which table. So now we're going to do a homework problem where we calculate how do we use the tables. So we're going to use a homework problem to illustrate that. So we're going to do short exercise 8-9. I love this exercise because it's so quick, but it shows you how to use the tables. So we need to, first of all, calculate the present value of $10,000 at the end of 5 years at 8%. So we're starting with that one. So $10,000 at the end of 5 years at 8%. It's one amount of money. We're getting $10,000 in 5 years. So what we're going to do is, which table to use? Well, present value of a dollar table is a single payment. So we're going to use the present value of a dollar table. So we're going to see this table pop up. And then what we're going to do is we are going to, what we need to do is we need to take the 8% and we find the column for the 8%. And then we take the period of time, which is the 5 years, and we go to the fifth row here. Okay. So the fifth row, 8%. So what we're going to see is we will see 0.681 as our factor. So we find the column for the interest rate and the row for the period, and we get 0.681. Okay, once you have a 0.681, what you do, it's really easy. You take the $10,000 and you multiply it by the 0.681. So that $10,000 times 0.681 gives you a present value of $6,810. The $6,810, if I put $6,810 in the bank today and the bank paid me 8% a year for the next 5 years, I would have $10,000 at the end of 5 years. So that's how to use the present value of a dollar table. Now our next one down, $10,000 a year at the end of the next 5 years at 8%. So $10,000 a year at the end of the next 5 years at 8%. So that is, first of all, answer the question which table to use. That's $10,000 a year. That means every year for the next 5 years. So we're going to use the present value of an annuity table. And what we're going to do is we are going to take the 8% at 5 years. So we'll take the fifth row, 8% column, and get 3.993. Okay, so that factor, what we're going to do with that is we're going to take the $10,000 annual payment, $10,000 times 3.993, okay, and we'll get $39,930. So we just take the amount of the payment times the factor. Notice that we don't multiply how many payments we're getting. That's built into the factor tables. A financial calculator and Excel will get you a more precise answer because they don't do any rounding. These tables are rounded to 3 decimal places, so there is rounding built in. You can use a financial calculator, you can use Excel for your homework. There's some tolerance built in for that. But for the exam, you need to be able to use the tables. You will not be able to use Excel or a financial calculator on the exam itself. Okay, and now I have a question coming up here. Okay, so this is going to be one of those point and submit questions. You received $1,000 3 years from now. So you're going to get $1,000 3 years from now. The investment pays 6% annually. What factor will you use to calculate the present value? Again, you cannot answer a text response. You have to click on the table itself. So click to the factor that you would use to calculate the present value of this. You're going to get $1,000 3 years from now, paying 6% annually. And I'm not asking you, from looking at the responses, that you have to point to a specific number. I've got a bunch of responses up where it says present value of $1. That's not what I'm looking for here. That won't be right. You have to point to a specific number and hit submit. And again, you can't type your number in. You're not going to get credit if you type a number in. You have to point to it, tap it, and then submit. This question is going to be open for about 10 more seconds. Again, I have someone, if you typed your number in, that's not going to give you credit. You're going to have to tap and click it. And we're going to be open for about 5 more seconds. And again, several people have clicked across the interest rates across the top, or the periods. Those answers aren't right either. You've got to pick a number and click on it. 5 seconds, Haley. Okay, so the factor is 0.840. So what you're going to do with that 0.840 in this problem is you're going to take the 0.840 times $1,000, and you get a present value of $840. And that would be the present value of that $1,000 you're going to get 3 years from now if you use a 6% rate. Okay, we have come to the end of class. Remember that we do not have class next week. Your job is to take the exam. I hope you have a nice spring break. I'll be in touch via email over the next week, and I'll see you then in 2 weeks after spring break.